Welcome to another audit walkthrough video from SuperfastCPA. I'm Logan, and in today's video, we're going to be going over Audit Area 4. This is Section C3. This is a remembering and understanding topic. Identify the factors that an accountant should consider when reporting on an engagement to review an entity's financial statements. And we're going to be doing that the SuperfastCPA way, which is diving straight into the questions to learn the material. Now, if you don't know much about our strategies, make sure you go to SuperfastCPA.com and sign up for our free 1-hour webinar training. Again, it is free. It is only 1 hour long, and we will teach you the key ingredients to passing the CPA exam so you don't waste months or even years failing the exam. And after you watch that, you're going to want to learn more, so make sure you also check out becoming a Superfast CPA Pro member. Pro members get access to the full 10-question versions of these 5-question YouTube videos. So again, we're only going over 5 questions in today's video, but Superfast CPA Pro members will get access to the full 10-question version of the video, which I will post in the member forum after I finish it after this video. So make sure you check out becoming a pro member if you like these videos, because you'll get a little bit of extra help from the full versions. Now, with all that said, let's dive straight into the questions. All right, here we are at question 1. Let's just dive straight in. Before performing a review of a non-issuer's financial statements, which of the following actions is the accountant required to take? Okay, so we're talking about reviews or review engagements in this video. Let's go through the options. Option A, test the operating effectiveness of internal controls over financial reporting. Option B, obtain an understanding of the entity's industry and operations. Option C, observe inventory counts at year-end to confirm physical existence. Or option D, recalculate depreciation expense for significant fixed assets. So what are they most likely required to do, or what are they most likely going to do when they're performing a review out of these different options? Now, if you know what a review is, then you might already have an idea. If not, though, that's okay. We are using these questions to start learning about this topic. So let's go ahead and dive into the explanation to start learning. All right, here we are. The answer is B, obtaining an understanding of the entity's industry and operations. So let's dive into this. In a review engagement, the accountant must develop a sufficient understanding of the industry and the entity's business to design appropriate analytical procedures and inquiries. This includes learning about the organization's structure, operating characteristics, and types of products or services. This foundational knowledge is needed for identifying the unusual items or relationships. The other options describe audit-level procedures that are beyond the limited scope of a review, which does not involve testing internal controls, physical inspections, or recalculations of account balances. And again, essentially, a review is much smaller in scope compared to an audit. You're maybe just reviewing one small portion of financial statements instead of doing an entire audit. So that's kind of the idea here, and that is why they would need to obtain an understanding, but they don't have to do the other procedures because those would be audit procedures. Now, we learned a little bit about what you're going to be doing for a review engagement in this question. Now let's go to the next question. All right, here we are at question 2. Which of the following procedures would not be performed during a review engagement of a non-issuer's financial statements? Okay, let's go through the options. Option A, inquiring about the collectability of receivables. Option B, performing trend analyses on revenue and expenses. Option C, comparing vendor invoices to recorded purchases. Or option D, comparing current financial results to prior periods. So based on what we learned in the first question, you might have an idea of what is going on here, based on what you understand about auditing so far. But if you don't understand and you don't know what this is trying to get at, that's okay. We are going to use the explanation to continue learning. So let's go ahead and dive into the explanation. All right, here we are at the answer. C, comparing vendor invoices to recorded purchases is something that you would not probably do in a review engagement. So let's go through this. Review engagements are limited in scope and do not involve substantive procedures, and we've talked about those in previous videos, such as inspecting source documents, confirming balances, or testing transactions. Comparing vendor invoices to purchases is a substantive audit procedure, which is not appropriate in a review. Instead, the accountant applies analytical procedures, like trend or ratio analyses, and inquires of management to gain limited assurance. Options A, B, and D are all consistent with the scope of a review engagement. So you would inquire about the collectability of receivables. You would perform trend analyses. You would compare current financials to prior periods. That is something that you would do in a review engagement, but you would not do substantive procedures such as comparing vendor invoices to recorded purchases. So learning more about review procedures. Now let's go to the next question. Okay, here we are at question 3. Which of the following situations would most likely prevent an accountant from accepting a review engagement? Okay, let's go through the options. Option A, the client uses a special purpose framework to prepare its financial statements. Option B, the financial statements include a material gap departure disclosed in a footnote. Option C, the accountant lacks experience in the client's industry. Or option D, management will not provide a written representation letter for the period under review. So which of the following situations would most likely stop the accountant from even accepting a review engagement? Based on what we've learned so far, you might have an idea, but if not, again, that is okay. We're going to dive into the explanation right now. All right, here we are at the answer. D, management will not provide a written representation letter for the period under review. So that would be something that would stop an accountant from even accepting a review engagement. So let's dive into this. A written representation letter from management is required in a review engagement. Without it, the accountant must withdraw or decline the engagement as the review procedures cannot be completed. Using a special purpose framework, that was option A, lacking experience, that was option C, or disclosing a gap departure, that was option B, would not automatically prevent the engagement as long as the accountant complies with applicable standards and modifies the report when needed. So as long as they get the experience or the understanding that they do need, as long as they understand how to use the special purpose framework or what's needed, or as long as they disclose the gap departure, like modify the report because of it, then it's going to be okay. They don't necessarily have to not accept the review engagement or withdraw from the engagement. However, if management will not give a written representation letter, then they cannot do the engagement. So with that, let's go to the next question. All right, here we are at question 4. What should an accountant do if, during a review engagement, they identify multiple gap departures that are so significant the financial statements are misleading? So let's go through the options. Option A, withdraw from the engagement and provide no further services regarding the financial statements. Option B, modify the review report and include an emphasis of matter paragraph. Option C, issue a standard review report and note the issue in the working papers. Or option D, issue an adverse opinion due to the pervasiveness of the gap departures. Okay, so based on what we learned in the previous questions, especially in question 3, you might have an idea, but this is kind of building on something we learned in question 3. So if you don't know, that's okay. But if you want, pause the video, think about this, and when you're ready, come back. We'll look at the answer together. All right, here we are. The answer is A, withdraw from the engagement and provide no further services regarding the financial statements. So in the third question, we learned that it's not necessarily going to cause them to always withdraw from the engagement if there are departures from GAAP. But in this one, we're building on that a little bit more. So let's kind of understand that. If the financial statements contain pervasive departures from GAAP and management refuses to revise them, so those are the two things that are happening here that are a little bit different from the third question, the accountant must withdraw from the engagement. So if there are departures from GAAP, but they're, not pervasive and, as long as management does fix them, the accountant can modify their report without having to withdraw from the engagement. But in this situation, again, because they're pervasive and management isn't going to revise them, then the accountant has to withdraw. A modified review report is only appropriate when the deficiencies can be adequately described to prevent the financials from being misleading. Unlike an audit, a review does not provide opinions, such as adverse. So D is incorrect. And this right here is something you need to remember. Reviews provide conclusions, not opinions. So if you ever see a question asking about a review engagement, just know that it's never going to have an opinion, like an unmodified opinion, an adverse opinion, or anything like that. Reviews only give conclusions, not opinions. And again, we just learned there that if the gap departures are pervasive, then they're probably going to withdraw from the engagement. Basically, the only time, again, that you can do a modified review report is if the deficiencies can be adequately disclosed to not be misleading for the financials. But again, that would mean that it's not super pervasive and that management is willing to revise them probably. So with that, we learned a little bit more. Now let's go to the next question. All right, here we are at question 5. Which of the following items would most likely be included in the working papers for a review engagement? Let's go through this. Option A, a detailed evaluation of the client's internal control environment. Option B, copies of invoices and shipping documents supporting revenue transactions. Option C, documentation of inquiries made to management regarding significant accounting policies. Or option D, confirmations of year-end account balances sent to third parties. So again, which one of these is most likely going to be included in the working papers of a review engagement? Now, if you don't know, that's okay. But based on everything we've learned so far and kind of what you might understand about review engagements at this point, then pause the video and think about this. And when you're ready to come back, we'll look at the answer together. All right, here we are at the answer. C, documentation of inquiries made to management regarding significant accounting policies. So that is something that would most likely be in the working papers here. So let's go through this. In a review engagement, the working papers must document the inquiries made and analytical procedures performed, as these form the basis of the accountant's limited assurance. Internal control evaluations, invoice testing, and third-party confirmations are all part of audit or substantive procedures. Again, that is not in a review engagement. The review is limited to inquiry and analysis. Documentation should reflect that scope. So that's the only thing that should be in the documentation is inquiries and analyses. Now with that, we learned a lot about review engagements and what kind of goes into them. Before we do anything else, let's do one more part of the SuperFast CPA process called pillar topics. Now, the idea behind pillar topics is as you're going through the questions to learn the material, you will notice the things that keep popping up. You've seen 2 or 3 or 4 questions trying to teach you about the limited assurance that is given for review engagements or whatever the case is. Again, you notice these things popping up in the questions frequently. So you take a moment and write these down in your own words as the pillar topics, the key points of what you learned. And as you're doing this each day, you are building your own personal repository of the most important things you learned from the questions so that you are ready for the exam. So let's go ahead and take a look at the pillar topics for this video. All right, here we are at the pillar topics. Let's just dive straight in. First off, inquiries and analytical procedures. Remember, we just talked about that. In a review, the accountant applies analytical procedures such as ratio analyses or comparisons to prior periods and makes inquiries of management. These limited procedures form the basis for providing limited assurance. You're not doing too much more than that. You're not doing substantive procedures and testing and things like that. Then we're kind of following that up right here. No audit procedures. The accountant does not perform substantive audit procedures, such as comparing invoices to recorded entries or inspecting documents. Review procedures exclude testing, confirmation, or evaluation of internal control. Now let's talk about the preconditions that need to be met for a review engagement. The accountant must be independent, and we didn't talk about that too much, but now you know, and able to perform both analytical procedures and inquiries. If management refuses to provide a written representation letter, the accountant must withdraw from the engagement. And we did talk a lot about that one, the written representation letter. If that's not going to be there, then the accountant can't be in the engagement. And I threw in there that they do have to be independent. That's something that I was actually going to go over a little bit more in the member version of the video, so just letting you know. But let's go ahead and go to modifying or withdrawing. If a gap departure is significant but can be described, the review report is modified. If the departures make the statements misleading and can't be adequately disclosed, the accountant must withdraw. So if you can't modify it without the financial statements being misleading, then you have to withdraw. And then finally, let's talk about the limited scope of the work. And we kind of already talked about this, but I'm going to talk about it a little bit more. Working papers must include the engagement letter, representation letter, and documentation of inquiries and analytical procedures. The review file does not contain audit level evidence or control evaluations. So again, those are kind of the basic things that you need to know for this blueprint topic about review procedures and review engagements. And with that, that is the end of the YouTube version of this video. Remember, SuperfastCPA CPA Pro members are going to get access to the full 10-question version of the video that I'm about to finish after I finish this. So if you like this, make sure you check out becoming a SuperfastCPA CPA Pro member, because again, you'll get access to the full versions. You'll get access to a lot of other stuff, including our Pro course, where we will deep dive in exactly what you need to do every day to pass the exams. It's like a much more expanded version of the webinar. And speaking of the webinar, make sure you go to SuperfastCPA.com and sign up for our free 1-hour webinar training. In that 1 hour, we will teach you the key ingredients to passing the CPA exam, and after you watch that, that will give you a much better path to learning about and becoming a SuperfastCPA CPA Pro member. So check out the webinar, then check out becoming a Pro member. Now with all that, I hope this was helpful. If you did find it helpful, and if you did like the video, make sure to like it and leave a comment, and I will see you in the next video.